In this video, I'm going to talk about current liabilities and some of the things that we need to be careful with. Before I actually talk about current liabilities, let's just talk in general what a liability is. So this corresponds to whether it's current or long-term. The definition, by definition, a liability is a present obligation with a probable future sacrifice. And that sacrifice is generally in the form of cash, but it can also be in the form of goods or services. And for purposes of identifying an actual liability, this idea of probable, it's an idea of probability, is very important. Also, the second requirement is that it be unavoidable. You cannot get away from paying this liability. And finally, the third item is that the transaction has occurred already. So if all three of these are met, then you have by definition a liability per GAAP purposes. Now, more specific to current liabilities, okay, so when we talk about current liabilities, you're assuming you've met these three criteria, but on top of that, we're going to have a few more things related to specifically current liabilities. The first thing is this: they're recorded at the maturity value or the face value. And contrast this to a long-term liability. A long-term liability normally is recorded at the present value of the future cash flows, not with a current liability. With a current liability, we're just going to state it and put it in the books at whatever the face amount is. The other thing is, for it to be a current liability, it needs to be paid with current assets or the creation of another current liability. Okay, so maybe you have a current liability that's going to be repaid with another reissued instrument that's a current liability, right? Like a refinancing. And if that's the case, then you can classify it as a current liability. I do have a side note here. If you currently have a current liability that is going to be refinanced, but it's not going to be refinanced with another current liability. Instead, it's going to be refinanced with a long-term liability. Then at that point, you may classify it as a long-term liability. And you got to be really careful with this, because most of the times a company would prefer to record or to recognize something as a long-term liability instead of a current liability. And the reason that's the case is because current liabilities create an urgency of having to pay something fast, right? Versus a long-term liability where the payment obligation is, as it states, in the long term, right? So because companies would be more inclined to want to classify something as a long-term liability, we have to be careful that two criteria are met. Okay, so let me say this again. You have something currently in the books that is recorded as a current liability. It's going to be refinanced with a long-term liability. If that's the case, then you can classify it as a long-term liability as long as you have the intent and the ability to do so. So in other words, once this current liability matures, you have the true intention, okay, of going forward and borrowing on a long-term basis. And not only the intention, but also the ability. So it could be in the form of a pre-approval letter. It could be that you have a line of credit already lined up, things of that nature. So if that is the case, if you have a current liability in your books right now, and you're going to refinance it with a long-term liability, given that you have the intent and ability to do so, then instead of putting it on the balance sheet as a current liability, you can actually put it as a long-term liability. So that's kind of an exception there that you want to be careful with. But in general, this is the current liability is something that's going to be paid with current assets or the creation of another current liability. This here is an exception. What's the period we're talking about here? We're usually talking about less than a year or one operating cycle. Most businesses are operating on a yearly operating cycle, but there are some businesses out there that have an operating cycle that is different than a year. And if you do, then your short-term definition is based on that operating cycle. What's also included as a current liability? Any current portion of long-term debt. So if you owe some monies on a long-term basis, but part of it is coming due in the short term, then that part needs to be partitioned out and detailed. Okay, now here's some examples that are maybe not so common or that maybe not so obvious are current liabilities. Obvious ones are your accounts payable or things of that nature that you have to pay. But some of the ones that may not be so obvious is things like dividends payable. So even though a company is not required to pay dividends, once they declare that dividend at that point, then it becomes a liability, an obligation. And more specifically, these are short-term obligations. So you have dividends payable. Similarly, you have preferred dividends in arrears. So if you have preferred stock and you have dividends that have been unpaid in the past and they're in arrears, in other words, you have an obligation to pay them, that they become a current liability as well. Any monies that you receive ahead of time from customers, any deposits, so those are current liabilities until you provided the service or goods that those customers paid for. Same thing here with unearned revenue, right? And so unearned revenue is similar in nature to these deposits that you receive ahead of time. And lastly, a real important category is taxes. Usually all of our taxes are on a short-term basis. They're current liabilities. We here in the United States live under a pay-as-you-go system. And as those taxes accumulate, you have to turn them over periodically on a short-term basis. So that includes things like federal income tax for payroll, sales tax, all these other things that accumulate are short-term in nature. Okay? As an example, I'm going to provide here how we account for payroll, given that payroll usually gives rise to several short-term liabilities. Okay, so let me explain how I'm doing this. This is the accounting on the employer's book. Okay, so keep that into perspective. We're not doing the employee's books at all. But in doing the employer's books, obviously we have to consider information that corresponds to the employee. So that's what I mean by here. This is information related to the employee's part of it. And then on top of that, you have information that corresponds to the employer. So when an employee is paid, the employee has to pay federal income tax. And that percentage varies for everybody. It depends on how much you make, how many dependents you have, whether you're married, single, all those kind of things. And that percentage comes out from a chart based on those attributes, and then it's taken out from the employee's amount. Another one is the FICA, the Federal Insurance Contribution Act. That includes Social Security and it includes Medicare. So you have Social Security at 6.2% that gets taken out from the employee's amount up to a certain threshold. Every year that threshold changes. But once you reach that threshold in a calendar year, you no longer have to pay the 6.2%. Most employees do not reach that level and they pay 6.2% throughout, just because they never reach that threshold on a yearly basis. You also take out 1.45% of Medicare from the employee's amount. And then you subtract out any other items for which the employee pays. That could be insurance, medical insurance, dental insurance, anything that the employee is paying out of their paycheck. Could also be monies that they're putting aside for their retirement. Could be contributions to charitable organizations, many, many other things. And all those things that the employee is paying for, they would be listed as a short-term liability. So notice the journal entry right here. This is the part for the employee's component, right? So let me put some colors here. So with this, we have wages expense, which is the calculated amount that you promised your employees in pay. But then from that, we subtract federal income tax and we put it in a liability, federal income tax payable, short term. The amounts corresponding to FICA payable, short term as well. Any amounts that the employee is paying for insurance, whatever type of insurance that may be. And notice how it's a liability as well. Any retirement money is being put aside that the employee is contributing, and anything else. Okay, but the theme here is that all of these things are short-term liabilities. And then after all this is accounted for, then the employees get a cash amount of X minus all those items. So this is one of the journal entries that the employer has to do. The other journal entry that the employer has to do is their part of it, the employer's part of payroll. Believe it or not, the employer pays this amount X, but then on top of that, they're going to have to pay some expenses on top of that. And what are those expenses? Well, for starters, the employer is going to have to match the FICA amount. So whatever amount was here, technically I could have just put Z so it's the same. Let me change that. Whatever amount was here is going to be paid by the employer as well. Now don't get mixed up. This is being paid from the employee's paycheck, right? And that gets taken out of the employee's money. All the employer is doing is being the middle person of holding that money from the employee and then turning it over to the taxing authorities. Now, this is the employee's amount. The employer will also pay that Z amount. Okay, now this is actually coming out of the employer's money. Technically all of it is coming out of the employer's money because they're paying this, right? But the employee is getting X minus Z because they have to take it out of their paycheck. Whereas here, the employer is contributing an extra Z amount. Okay? The employer many times also pays for insurances, so any liability here for insurance, medical, whatever contribution they make. Many times an employee pays some part of it A, and then the employer pays some part of it F. And then same thing with retirement. Maybe the employer contributes as well to your retirement. And anything else, okay? So all these things start adding up. And I failed to include a big one here for the employer. So bear with me one second here. The employer also has to pay for state unemployment. So let's call this amount I, and federal unemployment. And we'll call this J. So all these added things are things that the employer has to pay by simply having an employee in the books. So let me add plus I and plus J. This right here, I'm going to color it in blue as well. So this is the accounting that the employer has to do anytime they pay employees. Yes, they do this part right here, but then they also end up doing this part right here. So having employees can be, the cost of having employees is not just what you pay your employees. You also have to pay all these extra things. This right here in blue is what we would call an employee-employer relationship. So I think that's important to understand in contrast to an independent contractor. So let me do that. Bear with me right here. Oops. I know this looks a little crazy, but I think it's important for us to understand something here. Okay, sorry, I'm doing this right here. All right, so everything that I've illustrated in blue right here relates to an employee-employer relationship. So this is when your typical relationship where you hire somebody and you control the output of what your employees do. And when that is the case, then you have an employee-employer relationship. Now, contrast that to an independent contractor. If you're an independent contractor, then the employer is not necessarily controlling how you do that work, right? They hire you for something, and they simply will pay you whatever the expense may be. Let's call it X here, the same amount X, let's say, and they would simply credit cash. So to treat somebody as an independent contractor, it's very much simplified. Contrast to an independent. It's a very easy accounting, right? Contrast that to the employee-employer relationship that I described right here. This is very different. When you have an employee-employer relationship, you have all this accounting to do. You have to make sure you meet those deadlines where you got to turn over these monies. There's very strict rules with that. But if instead you hire somebody as an independent contractor, this is it. You just pay them and you credit cash. You do not have to do any of the other things right here. And I mentioned this because sometimes certain companies may pay individuals in this format when you could argue they might be more of an employee-employer relationship. If you have an employee-employer relationship, at the end of the year, for tax purposes, you get a W-2. Okay, this is what you use to prepare your tax return. Whereas if you are an independent contractor, at the end of the year, you'll get a 1099 from the employer or the company that hired you. Okay, many times these are clearly distinguishable. Okay, you're either an independent contractor or you're an employee, but sometimes there's gray areas, and that's where you got to be careful to understand what that relationship is. Because if you do have an employee-employer relationship by definition, then this is the accounting that needs to be done. If instead you do have an independent contractor relationship, then this is the only thing you got to do. But the reason for this discussion on payroll is given that we're talking about current liabilities. And current liabilities exist in many of these accounts. These are all current liabilities regarding payroll. So keep that in mind. Okay, this concludes the video on current liabilities.